Our next panel, I'm going to introduce James Godfrey, who will be moderating a fireside chat. James is a good friend. James has over 30 years of investment banking experience. Previously to actually venturing into blockchain and more modern financial markets, James was a managing director at both Nomura and Bank, based in Europe, in the UK, where he led and grew the credit trading desks to be Europe's largest at Mizuho, which was a trading operation that spanned across various continents. Today, James is really focused on revolutionizing the financial markets with a high focus on using blockchain technology. He spent some time in the last few years as the CIO at Tagion and led capital markets at BlockX before actually joining us here at GDA as a senior executive. Today, James is focused on spearheading our lending operations, our FX operations, our banking, and our bond issuance product, which I'm sure he'll be getting into some awesome discussions about in the next few moments. And today, James will be talking about securities and the financial revolution, and really discussing how securities are changing because of the blockchain and the increase in financial technology today. So James, looking forward to hearing this discussion. I'll let you take it away.
Thank you very much for a very eloquent introduction, Zach. As always, excuse me. So today I'm joined by two friends of mine, Matt Cpae and Johannes Hanlein. Matt is a serial entrepreneur, 25 years experience in commodity-focused international trade. Following the sale of Petro Media Group, he got into blockchain and into cryptocurrencies, and now is something of an evangelist. I think that's right, Matt. Johannes, how can we describe you? Johannes, 25 years experience in corporate finance advisory, lead development and execution on a multi-family office, asset acquisition and investment strategy. So rather than try and cover the whole of capital markets today, what I thought we'd do is go down one avenue of capital markets and look at that in depth, that being trade finance. And by doing that, hopefully give people the idea of how that can then expand across to other markets and have other uses. So Matt, I'm going to keep it nice and easy for you. Tell us about trade finance. What is trade finance?
Well, simply, trade finance would be the funding of international deals between, you've got a supplier and a buyer. The supplier doesn't want to part with his goods until he's paid. The buyer doesn't want to part with his money until he receives the goods. But you've got 10 days, 3 weeks, 40 days between the two of them. So the purpose of trade finance is, basically bridging that gap, bridging the trust. I would argue trade finance was the foundation stone of international banking. Certainly merchant banking is trade finance.
What is the size of the marketplace?
I tell the size of the shortfall at present. The size of the marketplace is huge. Currently, there's a shortfall of between 1.8 trillion and 3.5 trillion, depending on which international banking organization you refer to. It's huge.
What sort of returns can people expect to get from trade finance, and what are the barriers to entry?
Well, I mean, if you're investing directly in trade finance, and the returns can be anything from 1% per month to 50% of your return in the same period. It depends on the risk you're taking. The tricky thing, really, or the thing that actually is where the money's made, is adjusting it for risk. So you're ensuring that actually your risk is covered off, and if you do that, then you can, as a basic idea, a basic explanation, default rate on export letter of credit is 0.02%, which is, without actually any structuring, would be a AA rated risk. On something like that, you could be looking at 4 to 8% return, depending on where the origin is and what trade you're looking at. If it's commodities, it'd be a liquid market, lower risk. If it comes out of North America or Europe, lower risk. If it's tractor parts to Zimbabwe, it's a higher risk, because if that buyer disappears, you've got nobody else to take the cargo on. You've got no way of reselling it.
Is there a different quantity of risk for coming out of or going into a hotspot?
Well, yes, and I mean, if you're going to do trade finance, you've got to do due diligence on your counterparties. So not only is it the entities at either end of the trade, it's also where the trade's happening, what commodity is. If you're going into a war zone, well, all bets are off. You can't get insured. You're not really sure the cargo is going to arrive. That would be considered a high risk. Okay,
so let's move on to the more fintech element of this. How do you think blockchain as a technology and cryptocurrencies as a technology can help this going forward? And how much do you think it's going to change?
Well, it's already changing very quickly. I mean, you've got, because it was such a staple for banks to make their money out of trade finance, because they basically had exclusivity to it for up until maybe 5 years ago, maybe 10 years ago. There's been no investment in their systems. So I remember talking to a very large Swiss bank a couple of years ago, and they're making very clear they're operating on paper documentation, sealed, signed, couriered, and they saw no need for actually having it electronically, electronic platform for any of the documentation. That's moved on hugely. Not only are the banks now retreating from trade finance because of the additional requirements for anti-money laundering or know your customer compliant, in order to be compliant with Basel III, Basel IV, the returns they were getting don't justify the compliance costs. So because it's so heavily overmanned, bringing in blockchain essentially reduces the costs hugely. You have doing a couple of notes earlier, and you've got kind of 70 to 30% drop in costs, be it for documentation, removing duplication, mid-office, back-office requirements. All those costs essentially are brought down when you remove duplication. You allow information that is already out there with all the counterparties to be shared in a secure environment on a kind of decentralized ledger. There's no need to duplicate and re-enter and that information multiple times in multiple documents and risk the inaccuracies that are bound to happen.
Johannes, I think we better introduce you at this point. So how do you think this is quite all right. How do you think things like the Internet of Things and being able to monitor constantly a cargo is going to alter? Because I understand cargoes can actually change hands several times as they move along their journey.
Yes, sure they can. It's like, so Internet of Things, it's like it makes it all visible. So it's a factor, but it's the controlling factor, and it brings that safety and security into these transactions, which are normally, miles away from anybody. So we felt, Matt and I, that when we worked on our own fund on that, is introducing technology helped an enormous amount of bringing that closer to us, and also then is like putting it into good perspective between a risk return, a sensible risk return. And my background coming out of the family office world is we have changed from we want to have 100% return to we want to make sure our capital is safe, and then we want to have a return on top of that. And so technology, I think, gives us more sleep at night.
So what are the barriers to entry for this market? Because we can see that talking about 0.02% of default risk, and default risk, we'll talk in a second about how that can change from cargo to cargo. But talking about such low default risks and reasonable returns, so let's say the 5 to 10%. So take excellent return. What are the barriers to entry for this market?
It's with like many of these interesting markets, it's your initial ticket size. And your initial ticket size as an investor is at a very high level. It's not the 5 million mark, but very often it's like for successful managers of trade finance, it's at the hundreds and thousands mark. So in a way, it's like if that barrier comes down, and that happens across the industry echelon, is like this kind of democratizing the entry to the alternative world. Here is an opportunity, is like, taking advantage of a market which is, shock dried out to the other extent, as Matt said earlier on. It's like when the banks retreated out of this market, when suddenly, we keep on saying, it's like the big white elephant left the room. So there's a big vacuum there. So the market is there, the demands is there. And in the current climate, it's even more important to look after that trade, even so people might argue world trade might have come to an end, but it's not the case. So we got you frozen, James.
High barrier to entry. So the man in the street. Can you hear me yet?
Yeah, absolutely.
Yes.
Okay, perfect. Right, so we can see there's a high barrier to entry for a reasonable return, and the whole world is looking for reasonable returns at the moment. So how do you think democratizing this, or the democratization of this market, with using cryptocurrencies as an asset class, how do you think that's going to affect it going forward, and how do you think it's going to work?
The moment, if you want to invest in trade finance, you're having to find a properly run fund, preferably one of scale, so that actually that default risk is blended into your risk. There are some that we've been working on with that could take a couple $100,000 investment. Basically, you're looking at $1 million minimum investment, going through a stringent KYC AML procedure, and then you're kind of tied in for maybe a lock-in period of 6 months to a year, most probably a year. If you want to get your money out again, it's probably 3 months redemption period. Where crypto comes into it, we're using digitizing a digital asset. You meet the requirements of both the fund and the investor. So if the investment in the fund is captured as a digital asset, far as the fund's concerned, it sits as sticky money. It can be there in perpetuity. As far as the investor's concerned, they actually now have an asset that they can sell on with the returns that come with it on the secondary market. And this is what this is the real opportunity that digitization offers trade finance funds.
So, what's the advantage of sticky money?
Well, from a perspective of the fund manager, that every quarter, every month, every redemption period, they've got to put money aside, basically to cover off those that want to redeem funds. That means that their utilization of that fund is going to be impacted. So, a good manager, could have 95% employed, but there's still 5% left waiting should it want to be redeemed. And the reality is a lot of managers will have 80% or less employed. Whereas if you've got sticky money that's there that is going to be there throughout the trade, you can take on transactions that have a longer lead time to them. You can stack up and leverage deals knowing that actually the money that you need to complete that transaction is going to be in the fund. It's not going to be called on. That's the advantage from the fund. So the returns are greater.
So from a point of view, let's say we go into another global financial crisis, we get GFC2. Presumably that has quite a large impact on how a fund manager can trade a fund, because he knows he's going to have the money all the way through the crisis.
Yeah, and particularly, I mean, in the original financial crisis, you had a number of people who essentially you had default. They held onto the cargo, and the most appropriate manner for the best thing for the fund manager to do was put it in storage and resell it when the market recovered. But from the flip side, you've got investors who've gone into financial crisis. They want to call in their funds. This mechanism would allow both to do what they need to do in order to continue with financial health. It would allow the investor to pull their money out, secondary market. It would allow the fund not to call in the most liquid, profitable trades in order to be able to meet redemption, but actually sit on the trade and deliver on it, even with a delay.
Johannes, you're our family office expert. How do you think family offices would react to, say, a coin being issued that was tied to a trade finance fund, as opposed to going directly into a trade finance fund?
You know, obviously,
because they do get a tradable asset.
You can start, you know, your experience in smaller tranches. And I think it's a very valid point Matt made. You have arguably a lot more flexibility also to redeem only parts of it. You're more flexible in selling one out of your several coins forward. And I find it from a family office perspective, if you see what is today out in the market, a lot of the family offices are well set in the private equity strategies, but this is money being tied up for very long periods of time, or they are well set in their, you know, call it the short-term liquid alternatives where the hedge funds are in there. But they will probably ask themselves, and that's what we did many times over, is the risk return, is that still in whack? And most of the time the answer came out is like, you know, it's tilted towards high risk, limited return. So this asset class of trade finance, and that's where we gained a certain love affair over the past couple of years, is a fairly steady, it's not a terribly sexy environment, but it's a very steady environment where, and then if you tilt the risk a bit higher, it's like you can do nicer and more interesting returns, or you can do the steady ship on it. It's a matter, ultimately, what's your what's your coverage, i.e. of the fund manager, how he, you know, utilizes his funds. Does he take a title to a cargo? Does he have a hand through to the cargo? If things go wrong, how long does it take him to execute his rights? And we've seen it in the banking world. It's like, you know, when you take a balance sheet, you know, hand through, it takes a long time. And sometimes the cargo has disappeared until you finally have the right to the cargo. But we've seen other examples where, you know, fund managers or trade finance managers is like took the title of the cargo, and if something went wrong and all parties agreed, is like, you know, this is not coming to a nice end, reaction times are much shorter, and recovery is most likely way above, is like your capital loss or capital potential loss.
One question I've always wanted to ask is how much difference does it make? How much difference does the cargo itself make? So do you view a boat full of handbags the same as you look at the same as a boat full of coal?
I mean, it makes a huge difference. So we always say the example is like, you know, the tractor engines for Pyongyang are not sellable to anybody else than the Pyongyang orderer, whereby the cargo of coal is very sellable on this open market. So if you were to own that title and you have the right to resell it because your initial counterparty is not taking it, it's a matter how quickly can you turn around. So it's of huge importance, and many funds will have a very dedicated way of in what they can and what quality of product and what type of product they can invest, and that will be priced into their returns. It will be priced into, it's like, their margins.
So what you're saying is that if you if you issue a coin which is when tied to a trade finance fund, it gives the man on the street access to a part of the capital markets he's never had before. So we're democratizing entry to a very lucrative marketplace, and also it's good for the fund manager because it's giving him. How do we think this is going to pass through to other factors?
How this is going to pass through into other areas of the alternative world?
Yes.
I think it's the way how, like, your colleagues at GA looked at, if you're democratizing ownership of real estate and putting it into smaller parts, I think we can look at with the same glasses. We can look at pretty much any asset class. And I think it probably becomes more important or more interesting, like, for asset classes where you as an investor have to tie up money for the long term, and looking for that optionality of an emergency exit in case you need to. So on the trade finance side, what I think is probably the most appealing is that calculation part for the investment world.
Do you think that the democratization of this market, and we're talking, let's talk yields of 6 to 8%, and if we compare that to if we compare that to current financial markets, so I looked up 3-month money this morning for German government market, German government bonds, that was minus 0.68%, and we've got US Treasury long bonds at 1.68%. Do you think that the democratization of this sort of financial instrument will drive down the price of trade finance across the globe, or is the need for trade finance so huge that it's just going to keep the rates high?
Right. My expectation is the latter. The need for trade finance is very, very sizable. There are, very standardized trade finance transactions to be done, which are not very lucrative from an investment perspective. But then there are others, very safe ones, very lucrative from an investment perspective, because very often these people requiring the trade finance will not meet the standards the banks are putting out today. And very often you can even argue the standards are being put out there by the banks of actually shying away or sending away their potential customers. So this is a massive global market with a great opportunity and a massive appetite for funding.
I was saying earlier, the shortfall is so huge that it's unlikely that that the price, the return on investment in it is going to be impacted at all for some time. I mean, it's up to, I think Standard Chartered only last month was stating that it's a $3.5 trillion deficit that's currently being filled by the large trading houses like Glencore, Trafigura, Vitol, Cargill, rather than the banks, who really are retreating from it.
And I guess,
well, surely those trading houses aren't big enough to sustain that.
They're not. I mean, and hence the shortfall in funding. And where they are getting involved in the market, they're basically taking a trader's margin, which, fantastic. But if you,
sorry, what's the trader's margin for us uninitiated?
Will be substantially larger than a trade finance margin on it, which basically from a a fund manager perspective, you want to have maximize regular risk-adjusted returns, so that you're typically bringing in ideally 6 to 7% without actually incurring any risk, or any more than you really need to. Whereas a trader, well, they'll be able to trade in and out of the situation. They would look to maximize that, recognize they lose on some and gain on others. And
presumably there are ETFs and MTNs out there that the man in the street can invest in, but presumably not that many of them.
There are,
and
not that many.
If we see presumably, if we have a democratization of this market by coin issuance to raise finance, that is going to make a significant impact. How long do you think it's going to be before we start to see that start to take hold?
So to see what take off.
To see coin issuance to be put to raise finance to be put into the trade finance world. I mean, compared to some of the very, very sexy returns that we see in the cryptocurrency world, this is totally different. Can we talk about ratings for a second and exactly how safe your money is in this world?
Well, I've been talking to a couple of exchanges who have pretensions and desire to be banks or to be financial institutions. A stable coin, wrong term, a trade finance coin that's giving a stable return rather than a stable coin is attractive. I mean, they have options basically to trade speculative, a large portion of speculative STOs, which may come through, may not, but you're basically investing early on into a venture, or a stable coin whereby you're investing in US dollar or euro assets. There isn't actually anything in between, or very little in between, which could take large volumes of money and give you a nice, excitingly boring return of 5%. And that's basically what we're trying to offer, or what this would offer.
I'd like to just say that excitingly boring, I think, is the best way I've heard to describe trade finance. Gentlemen, I think I'm being wound up here. Okay, I will happily sit down and talk trade finance with you all afternoon. You know that. Can I just say thank you very much for joining me this afternoon. Over to you, Mr. Friedman.
I think we have we can go over for 3 more minutes to just go into the Q&A. Are you able to see the questions there, or do you want me to read them out?
Right, okay. How does, or is it necessary to have control or at least sight of the investors in the trade finance fund? Can this be managed via blockchain? And that is from an anonymous attendee.
Yes, it can. So you would have effectively be placing money like a money manager into a coin structure. And you would go through the due diligence with that entity, and your investment from the perspective of the fund would be the entity that actually bought that block of coins in the first place. You would then buy your coin, and you'd have to do due diligence with that entity. So you're one stage removed. I'm not sure that made sense. But
I think so. If not, the guy that asked that question has just texted me, so thanks for that, Dan. And I can always put him in touch with you afterwards. The second question we're being asked is why are the banks retreating, which is a very valid question. Is it outsized risk or just reg cap issues?
It's liquidity issues. So it's like the Basel III and Basel IV is like will require the bank, when they take it on their balance sheet, to secure that with extra liquidity they have to take on their balance sheet. Now, as the margins are not juicy enough, the banks have decided these margins are verify taking on extra liquidity. And this was in particular in markets where even for the banks to get extra liquidity onto their books is not the cheap way. So in that way, it was a kind of a natural progression. You know, the stronger the ties are, it's like on the regulatory side for the banks, which opened these floodgates in the market for, you know, the private investment to come in.
Okay, I think now we're being hustled off, aren't we?
Yeah, thank you for that, guys. I appreciate addressing the questions. Definitely a lot of interesting perspectives on trade financing, and I think you know, it's an awesome conversation to be having today and gives some great perspective. As always, I encourage you to reach out to James, Matt, or Johannes, who can leave their information below. You know, there were certainly some other direct questions that we might not have had the time to answer.